Stop what you're doing. Seriously, if you own or even just follow biotech stocks, you absolutely need to hear this. Last week, I ran Celldex Therapeutics through 5 different valuation models and 2 legendary checklists, and honestly, what I found completely shocked me. We are looking at a $2.5 billion company that is essentially pushing all its chips to the center of the table on one single drug. It is the ultimate high-stakes biotech gamble, where cutting-edge clinical science meets massive financial risk. Now, I know firsthand that the ultimate fear for retail investors is betting your hard-earned cash on a single asset pipeline, only to watch it crater overnight if a trial fails. It's a terrifying thought. But what if I told you that analysts are projecting a massive 85.91% upside for this exact stock? That's right. So you really have to ask yourself, is this a hidden Warren Buffett-style value play buried in the volatile biotech sector? Or is it a classic Peter Lynch trap just waiting to catch unsuspecting retail investors? Well, by the end of this explainer, you will know exactly which one it is.
To get there, I promise you a clear, actionable framework you can steal for your own research. Here is our roadmap for today. First, we're unpacking the high-stakes biotech gamble. Second, we'll look at the science, specifically targeting the mast cell. Third, we'll analyze their financial runway. Fourth, we're going to follow the money with some insider trading signals. Fifth, we'll navigate the intense competition. And finally, number 6, we'll break down the massive Phase 3 catalyst. Let's jump right in. Section 1. The high-stakes biotech gamble.
So what actually happens when a $2.5 billion company bets its entire future on just one single drug? Well, as we just talked about, it creates that ultimate retail investor anxiety. Celldex's entire destiny literally hinges on this one drug called barzolvolimab. Think about it. If this works, it's an absolute blockbuster. But if it fails in these late-stage trials, the floor drops out completely. There is zero middle ground here. It's a pure binary event. But despite that enormous existential risk, Wall Street is shockingly bullish on this one. Analysts project a massive 85.91% upside, giving it an average price target of $58.43. But we can't just blindly trust the analysts, right? Does this data actually make sense when you look under the hood? To figure that out, we have to look at the actual science.
Which brings us to Section 2, targeting the mast cell.
The entire core of this thesis relies on barzolvolimab. Yes, it's a bit of a mouthful. It is a monoclonal antibody designed to treat really severe, debilitating inflammatory diseases like chronic spontaneous urticaria. Now, how does it actually work? Well, it uniquely binds to the KIT receptor on mast cells. And since mast cells are the ultimate drivers of these severe allergic reactions, this drug potently shuts down their activity right at the source.
To put that into perspective, think about the current standard of care. Things like your basic antihistamines. They act like a Band-Aid. They're really just managing the surface symptoms. Celldex's approach is entirely different. By going straight to that KIT receptor, barzolvolimab effectively flips the off switch on the mast cell entirely. This novel mechanism of action isn't just treating the symptoms, it's literally shutting down the engine that's causing the disease in the first place. And honestly, that explains why their Phase 2 clinical data was so transformative. Section 3. The financial runway.
Now, groundbreaking science requires a mountain of cash, and the Q1 2026 earnings highlight a staggering contrast. Check this out. Total revenue for the quarter was a microscopic $15,000. Meanwhile, their research and development expenses absolutely dwarfed that at $73 million. That led to a net loss of over $78 million in just 3 months. And most critically, out of that $73 million spent on R&D, over $62 million was poured directly into advancing the barzolvolimab program alone. They are all in.
So you're probably wondering, how does a company survive that kind of massive cash burn? Well, it all comes down to the biotech cash runway. Despite those heavy losses, as of March 31st, they were sitting on $451.5 million in cash reserves. And then they doubled down. In April 2026, they executed a public offering to raise another $345 million. This absolute fortress of capital is absolutely crucial. It successfully secures enough cash to fund their operations completely through 2028. It buys them the exact runway they need to finish these clinical trials.
Section 4. Insider trading signals. Okay, let's inject a little human element here and follow the money. Right around the turn of the year, we get incredibly mixed signals from senior leadership. In December, the senior VP and general counsel dumped over 4,000 shares on the open market. But then, almost immediately after, we see the exact opposite behavior. The chief business officer exercised options for over 19,000 shares, and that was followed weeks later by the CFO exercising options for nearly 5,000 shares. It is a fascinating tug-of-war of insider sentiment right as they enter their most critical year.
Section 5. Navigating the competition.
Now, we have to be objective here. Celldex is not operating in a vacuum, and the threats to this company are severe. They are walking into an intense rivalry against entrenched pharma giants like Novartis and Sanofi. We're talking about titans with virtually unlimited resources. Furthermore, even if Celldex survives the high risk of late-stage clinical failure, they are going to face brutal payer hurdles. Securing favorable formulary placement and fighting off rebate demands is going to be an absolute war. And again, their near-total reliance on this one single drug means any little setback is fatal.
But to balance out those threats, they are bringing some serious ammunition to this fight. They are armed with an FDA fast-track designation, and their clinical data points to some genuine best-in-class efficacy potential. Backed by that freshly reinforced $500+ million cash position we talked about, they executed brilliantly by completing their global Phase 3 enrollment 6 months ahead of schedule. They've secured almost 2,000 patients. So David is definitely not walking into this Goliath fight empty-handed. Section 6. The Phase 3 Catalyst. A recent SWOT analysis summarizes this entire situation perfectly. It says, the primary determinant of its future is converting its lead asset's clinical promise into market success, a category challenger. And that really hits the nail on the head. Everything we've covered today, the novel mast cell science, the massive cash burn, the strategic maneuvering against big pharma, it all funnels down into one massive impending binary event. The Q4 2026 Phase 3 top-line data readouts. So I want to leave you with this final thought. Will barzolvolimab's upcoming Phase 3 data justify this billion-dollar gamble, or will that severe single-asset risk become a very painful reality for investors? The clinical promise is undeniably there, and the financial runway is paved, but the ultimate test is approaching fast. The results in the fourth quarter of 2026 could permanently dictate the future treatment landscape for inflammatory diseases. Thanks so much for joining me on this explainer.